Buonasera e bentornati. Vi ringraziamo di partecipare a questo contenuto che riguarda appunto, come dice il titolo, Bridging the Theory and Practice of Investor Profiling. La presentazione è di una survey realizzata proprio in Italia e sono contento di avere qui con me la persona che ha coordinato questa attività. Si tratta del dottor professor Jürgen Vandenbroucke, che è general manager di una società che si chiama everyoneINVESTED, che è un bellissimo nome, che significa appunto che tutti dovrebbero essere investiti. Everyone should be invested in financial markets. That's the meaning of your title.
Exactly.
Piacere appunto di presentare Jürgen. Qui con noi arriverà anche il dottor Raffaele Zenti di Wealthype, che è impegnato in attività universitarie ma ha promesso di collegarsi nei prossimi minuti. Ma per il momento I will give the ground to Jürgen. Ecco che è arrivato anche Raffaele Zenti, che saluto, ti ho appena presentato, vedo che sei in trasferta. Abbiamo qui presente Jürgen, is with us, and I give the ground to Jürgen to go ahead with his presentation.
Okay.
Parlerà inglese, ma un inglese molto semplice, spero insomma che sia seguito da tutti. Okay, thank you, Jürgen.
Yes. Thank you, Massimo, for the kind introduction, and welcome everybody. Thank you for your time this afternoon. I said I will share with you the results of a survey that we recently did in Italy, but I will also first show you what exactly we did before we go to the results. As Massimo said, I'm representing a company called everyoneINVESTED, but this survey is very much a part also of my academic agenda, let's say. As mentioned, I teach financial engineering and behavioral finance here at universities in Belgium. And it's very much aligned with the ambition of everyoneINVESTED, which is to make investing easy, personal, valuable, and reliable. And that includes knowing yourself as an investor. So risk profiling is, for me, a part of the start of an investment journey. It's a possibility, an ability to learn yourself better as an investor, and also for advisors, of course, to learn their clients better as investors. So what we do as everyoneINVESTED, and what we have done in this survey, is to build tools, technology that helps people to give information on how they feel with dealing with risk and reward, the balance when you start to invest. And this particular survey was focused on how can we generate and obtain data of high quality that we can use to have more personalized services in a digital world, and in such a way that it helps advisors, but also clients, to make a more personal and conscious investment decisions. So that's the general setup. How can we digitally generate data of high quality to serve the clients more personal in a digital world? And what we in essence do is we apply the work of this person. You may know Daniel Kahneman as one of the founding fathers of behavioral economics. And it's basically his work that we applied to have this survey in the Italian market. So what we do is the following. We ask people in a digital journey, so going to a website, they see a number of screens, and we ask them to tell us what their preferences are. If we show them a number of situations, we ask them, do you prefer one or the other? And I will show you in detail what this was, but before we start the details, it's important to realize the setting of what we try to obtain. We try to obtain what it says here, the quantitative, so the numbers that drive the person's behavior, both from a rational point of view, if the person really thinks about the decision in detail, but also more from the emotional part. What happens if we ask you for a sudden reaction? And the way we do this is we present situations that are of three different kinds. In one case, there's only gains, everything is positive. In another setting, we have a combination of gains and losses. And in a third situation, there's only losses involved, so everything is negative. So this is what we call a granular context. We ask about clients' and persons' behavior in these three different settings. And what we ask is always very simple. We ask them to make a choice between two possibilities. One possibility is a certain outcome where you know what's going to happen. And another outcome is here on the slide, here on the right-hand side. There's two possibilities. It's uncertain what will happen. It's like throwing a coin in the air with two sides, and both sides have the same probability of occurring. And people have to say what they prefer in this particular case, and then we move to a next screen. And we do this a number of times in these three different settings, each time offering these two simple choices to make. And the end result is what we call one single but exact measurement of how your thinking is going on when you think about risk, think about gains, and think about losses. And ultimately, that's what we do. So we obtain and we then show the clients what their financial personality is. And we tell them how risk is involved and impacts their decisions, how the information that we present impacts the decisions, and how sensitive they are to losses. And the scale of how low or how high your sensitivity is linked to the many other people that we have in our database. So if you are very much on the left or very much on the right, you are so-called more of an exception. If you are moved more to the middle, then you are more like most other people. And it is important that we show these three things separately, because has also an element of, let's say, financial literacy. We want people to reflect on the difference between risk and loss, for example. So it's also there that we want to help people to make a reflection on their own behavior, on their own financial personality, so that they know better what drives their behavior when they start to invest. And this is the kind of survey that we have done already now in a number of countries. So all the flags that you see here are the countries where we have done a similar survey. But the one in Italy was also done recently, where what we do is we build a website temporarily where we invite people to go, and then they have this survey with this screen flow with the choices they have to make. And we collect results and we close the website whenever we have 5,000 observations, because 5,000 is considered, okay, sufficient to do sensible statistical analysis and so forth. So here we have slightly more than 5,000, simply because when we close the website, there are still some other people more than 5,000 in the journey to continue and generate the data. So we have a little bit more than 5,000, but collected in only 6 days. So it is something that apparently is sufficiently attractive for people to go and visit, because in only 6 days we have more than 5,000 participants. Also interesting are the other numbers on the slides, because we want, as I said, everyone invested is addressing everybody, also those people that do not invest yet today. And maybe it's specifically those people that we want to reach with this kind of tools. So what we have in our data set here in Italy is, well, a good mixture of men and women, 48.4% female participants. The median age was 48, which is, I guess, lower than the average investor that we see across Europe. And that's indeed the case, because what we have in our database is 41% of people that invested before. So a majority of 59% of the participants have never invested before, which means that by definition, they have never done a risk profile before. So that's again for me a good indicator of we are reaching here an audience that perhaps still has a long way to go towards a full conventional investor client. And a starting point is this kind of tools to know more about yourself and about your behavior. So let me share with you what the kind of results we had. For today's webinar, I have a number of results to try to tease your interest, but of course we can follow up bilaterally if you want and give you more detail. But I will try to tease you and ask you, think about this dart mentally, think about this dart, take it in your hand, and on the next screen, then you have to throw it to your screen, but virtually, of course. And there's two possibilities. And this is an example of the survey indeed. So here we have a situation where you could throw your dart to the left-hand side of the screen. And if you hit the left-hand side, then you will be sure to receive 500 euros. There's also another possibility. You could also throw your dart to the right-hand side. And if you do so, then there's two possible outcomes. If your dart hits the gray area, then you have no gain, nothing happens, 0 euros. However, if you are able to reach and hit the dark green area, then you will receive a much higher amount, twice as high actually, 1,000 euro. And to make it a little bit more realistic, of course, knowing how to play darts is one thing, but in financial markets, it's not necessarily predictable. So if everything goes well, the animation should now show that on the right-hand side, the wheel is turning, moving, which makes it harder to hit the gray or the dark green. But that's, again, just to add realism and linking it to investing. So if we ask people this kind of setting, well, it's not as innocent perhaps as it may seem, because if you realize and you think about this carefully, then you could say, I am sure to receive 500 euro on the left-hand side, but before I throw my dart, the right-hand side actually also has 500 euro, but only in expected terms. I expect to have 500 euro also on the right-hand side because there's a 50% probability of getting nothing and there's a 50% probability of getting 1,000. So thinking again about this carefully, you could say the only thing that is different between left and right is the risk it entails. Because the left-hand side, the 500 euro is sure, and the right-hand side, the 500 euro comes with a risk. I have to be able to hit the dark green, otherwise I get nothing. So we did, and if you think about this like this carefully, then you would say perhaps if the expected value is the same left and right, I prefer then the outcome without the risk. And that's indeed what we see, not only in Italy, but also in all the other markets where we have done this. A vast majority of people, and in Italy it's almost 81% of the people, click on the left-hand side. And of course, we ask more of these things, more of these dilemmas to know a bit more carefully what the driver is of the person's behavior. But just as encounter of our survey, what we find is that, yes, in this kind of setting, a vast majority of people choose the side that has no risk. And this already helps us to understand a number of things. You may know that Markowitz, one of the founding fathers of modern finance, he once said, people prefer more to less, but dislike risk. Everybody prefers 600 euros over 500 euros if everything else is the same. But if I have two options that both have 500 euros, like in the previous slide, then I prefer the one with no risk. That's actually a crucial assumption in finance. That's the reason why we have a risk premium on top of the risk-free rate if we start to invest. That's why we think diversification adds value. So it's a very, very crucial element of finance. And it's an important observation that we find this confirmation in a survey like this, where, again, a majority of people have never invested before. What we also find in more refined way is that typically men have a higher risk appetite than women, meaning men give more daring answers than women. And also what we find is that younger people have a higher risk appetite than older people, which in many cases, if for advisors, I think it's confirming what you know from daily practice. But again, it's quite powerful as a result here because people went to a website, nobody helped them in completing this survey. Most of them have never invested before, and we nevertheless can retrieve through this simple survey a confirmation of established findings like this. And let's continue, if I may. Let me show you another similar situation, but now all the numbers have a minus sign in front of them. So now again, we ask people to choose and throw their darts to either the left-hand side or the right-hand side of the slide. Same principle, we make the wheel turn, so make it more difficult to hit on the right-hand side. And what we see here is, well, perhaps something that is strange, but it's in essence the finding of Daniel Kahneman. He was able to show that, look, nothing has changed, but only the negative sign. It's still the case that on the left-hand side, you are sure to lose 500 euro. And on the right-hand side, you will also lose 500 euro, but with risk attached to it. You can have no loss, or you can have twice as much loss, 1,000 euro. So only changing the frame from gains to losses makes people make a totally different decision. Now there's only a minority of people that click on the left-hand side. And that's in essence the finding and what made Daniel Kahneman earn his Nobel Prize. He said, well, people are not necessarily risk averse. In this case, a majority of people choose the risky side, the right-hand side. And he was able to show that people, for example, are much more tolerant for risk if it creates the possibility to avoid a loss. And that's the kind of refinement that we find also in our survey. So here, the Kahneman pitch line, his famous sentence was, losses loom larger than gains. And that's in essence what we find. People are willing to take risk if it creates the possibility to avoid a loss. And we also find that people indeed choose not between things. People don't choose the risky or riskless option by definition. No, they choose between the representation of things. If we show it as gains, people take the riskless option. If we present it as losses, people take the risky option. And another finding is that we find, which is also confirming other research, is that on average, people with higher educations have more loss averse behavior. So in essence, what we find is a validation of what we already know from other research. But now the big advantage is that we are able to measure this accurately at the individual level and in a way which is purely digital. So nobody helped these people to complete the survey. And two more things. People actually like it. If we ask people, did you like what you did as a method, not necessarily the result, but the method, so saying left and right all the time, people say, yes, it made me think. Yes, I think it was worth the effort, and yes, it was easy to do. So there's a very high confirmation of this being an easy task. So people like it actually, which is a good thing. Of course, it's a necessary thing if you want people to generate these data. And if we then generate these data in a digital way, because people like it, then we all know that in this world of digitization, these data are very valuable. So that's why we then asked people, would you be willing to share those data with your advisor or your financial institution if they would offer you that possibility? And then we see a big majority, more than 2/3 of the people, so 72%, said, yes, I think my bank should generate these data. And yes, my bank can use these data to give me more personal services. Actually, the one that is having the highest response rate is that they say, yes, my bank can use this data to give me more personal products and service advice. So this is very powerful as well. The fact that the data is high quality, it's good, it's nice. The fact that people like the journey is a necessary condition. And the fact that people are willing to share the data is, of course, crucially valuable in a digital world where you want to offer your client more personal services and not give everybody the same advice. So that's why finally we think this is also having a higher ambitions. This could indeed also qualify as risk profiling, more than as innocent and very sweet financial personality. It could also qualify as hardcore risk profiling for MiFID, because we have indeed implemented this as part of MiFID suitability, and yes, it has passed the test of being compliant. So in short, this is what I wanted to share with you, a highlight of the survey that we did, an essence of the results, pointing at the fact that people like it and are willing to share the data. If you would like to see more detail, then you can contact me or via Mr. Scolari for the further details. And I'm happy to take any questions, of course, now as well, if you have some things you want to be to have clarified. So, thanks for now for your attention, and happy to take any questions.
Thank you, Jürgen. Very clear and very interesting your presentation. Non so se adesso Raffaele, se è ancora con noi, se è collegato.
Mi senti?
Ah, ok, eccolo qua. In the dark side of the moon.
Mi dispiace, ma sono ancora in movimento, quindi mi scuso, ma ci tenevo molto a partecipare, tra l'altro molto interessante.
Spero che tu sia riuscito a seguire la presentazione di Jürgen. Diciamo, Raffaele lo presento io perché, a parte la nostra amicizia, è anche un bravissimo data scientist e lavora naturalmente nella società che ha fondato, che è Wealthype, ma qui è stato invitato un po' per fare qualche domanda a Jürgen o darci qualche sensazione anche di come ti è sembrato. Prego.
Grazie, lo dico prima in inglese, poi anche in italiano, così siamo tutti, siamo tutti contenti. So, first of all, congratulations, because this paper, in my view, is something that successfully translates theoretical insights into practical tools, and this is something we as a financial community, something we need, because it helps financial advice evolve toward a more realistic understanding of investor decision, including behavioral traits, of course. So it's a valuable contribution, in my opinion, especially for those working. Mi sentite?
Sì.
Okay. Especially for those working directly with the customers, like financial advisors. So, having said this, I think I have many questions, many possible questions, but the first one, it's about operational integration. I mean, basically in this paper, you introduce loss aversion, which is an additional behavioral parameter alongside the risk-return preference. Of course, I had your paper, so I have the full picture of your framework. So the question is, in practice, advisor need some synthesis, a model that helps them turning everything into a portfolio proposal. So the question is, how do you envision this integration as a separate input in a formal optimization model, or maybe just also, for example, a myopic loss aversion model, something like that, or as a qualitative adjustments to the portfolio composition and client conversation. Lo dico in italiano, quindi diciamo, al di là a me è piaciuto molto il paper, credo che sia un contributo importante per, diciamo, portare una buona teoria nella pratica di tutti i giorni, è quello che cerchiamo di fare anche noi in Wealthype. E la domanda è un po', in questo modo viene introdotto un parametro che è la loss aversion, che si aggiunge diciamo, alle preferenze di rischio rendimento, e addirittura, anzi poi dopo magari ci torno, è negativamente correlato o comunque indipendente, debolmente negativamente correlato. Allora la domanda è: cosa consiglia di fare con questo parametro? Di usare un modello formale di ottimizzazione oppure di usarlo qualitativamente per creare poi una raccomandazione di portafoglio, perché poi alla fine lì bisogna arrivare.
Please, Jürgen, I hope that you understand well the question from Raffaele. Yeah. Please.
I understand the English version of the question very well.
Yes.
No, very good question indeed. But there's two things I'd like to separate. What I focused on here today is indeed how easy it is, so to speak, to generate these data in a digital way, even from people with no experience. So it gives you more information, more commodity, more tools to work with, and have more people invested. So the first translation is from these data into a risk profile. And that, I think, is important to mention, that the definition of the risk profile based on the data that I just shared, that is something which can be done, integrated in full consistency with what a bank currently does. So we have implemented this, for example, in the context of KBC, which indeed is what is referenced in the paper that you refer to. And there was one particular way to turn the data into a profile. But we have also implemented the same tool for the data generation with another bank where they have 5 risk profiles, or where potentially they have 7 risk profiles. So I think important to mention is that our tool, so our technology, is capable of generating more data for profiled investors, but the link between the data and the profile of the client can be fully consistent with the existing methodology and the existing approach of the bank. And then indeed the second step, or the next step, is how do you link to that profile a model portfolio or a portfolio advice that includes loss aversion. Also there's a number of possibilities. A famous way, a popular way to do that is by using goals-based investing, where they say, well, the risk of a client is not the volatility of the portfolio, but the risk of a client that is in a mindset trying to achieve a goal. The real risk there is not to achieve the goal. And doing better than the goal is not a risk. So there you could say, if you are operating in a context of a goals-based investing, then the loss aversion parameter can be quantitatively or qualitatively, as you said, be linked to the probability of not reaching a goal. We have also implemented this in another way. And again, I'm just hinting on the fact that there are multiple ways to do that. Another way is to say, well, and that's more, let's say, theoretical perhaps, or more based on theory, but Markowitz, the modern portfolio theory, they said, well, the number of equity, the percentage of equity, percentage of bonds, and so on. So the composition of your portfolio is linked to the client's risk aversion. A higher risk aversion means less equity, more risk. Sorry, a higher risk aversion means less equity. Lower risk aversion means more equity. That's how we do it in many cases. Then you could say, well, now I will link the risk aversion to the allocation of the portfolio, and I will alternatively link the loss aversion to the management of the portfolio. Meaning, if a client has a very low loss aversion, I will not touch the allocation and I will stick to my long-term benchmark. However, if my client has a high loss aversion, then I will, based on market situations, I will adjust my allocation more frequently in order to channel and to address the loss aversion of the client. Now, both of these are documented, they are implemented not only by ourselves but also by others. It's a way of introducing behavioral finance into the advisory services of investing. And goals-based, as I said, is one way of doing it. Another way of doing it is by making the allocation as well as the management of the portfolio linked to the profile of the client. I don't know, Raffaele, if that answers your question, but it gives you directions of how you could do that.
Yeah, I think it was quite clear, your answer. I hope it's also clear for our audience. So thank you. And so I don't know if you have some question, Massimo. Otherwise, I have at least one more question,
Please.
which is about it involves dynamics. What I mean is that there is a dynamic dimension in all the behavioral traits because things change. Sometimes in a structural way. So, for example, if I receive a lump sum, I'm happy, and this probably, if it is a large amount of money, it's something that change my perspective, so my behavior, but also might change on a kind of a daily basis, based on, for example, on market shocks. If I see terrible news about the financial markets on newspaper, maybe if I'm the normal Italian investor, maybe I can get scared. So the question is, it's not a question, maybe it's just something to discuss. Do you plan to consider temporal variations in loss aversion, and especially measuring? I think it's nice, the exercise, the theoretical exercise on a website, but probably there is nothing like reality. And so it might be of interest to estimate loss aversion directly from the actual behavior of people on their portfolio. So if after a market shock they sell risky assets or whatever, we may collect relevant information. Do you plan to do something like that? Because it would be interesting from my point of view. I think also from the point of view of our audience. Traduco in italiano, quello dicevo, c'è una dimensione temporale anche nella loss aversion, che può cambiare per motivi strutturali, non so, eredito, ricevo una donazione, insomma, oppure cambia il mio reddito, cambia la mia ricchezza. Questa cosa qui probabilmente cambia anche alcuni miei parametri comportamentali, come la loss aversion, ma potrebbe anche cambiare, e chi meglio dei consulenti finanziari lo sa, che a contatto con i clienti, potrebbe cambiare anche
eventi esterni,
perché appunto succede qualcosa sui mercati, i giornali, la televisione pompano la notizia, le persone si impauriscono, quindi diventano, magari localmente in quel periodo diventano molto più, magari credo che sia esperienza un po' di molti di voi, cioè di avere concordare in un periodo tranquillo, in una serata tranquilla, un certo tipo di strategia di portafoglio, e poi però al primo sussulto serio del mercato essere chiamati e dire oddio no, adesso cosa facciamo? Quindi è una cosa molto comune. Quindi la domanda è se questa cosa qui si può includere, se ne può tenere conto, si possono trarre informazioni per stimare la loss aversion da questi eventi.
Jürgen, did you understand the question in English?
Yes. Yeah, it's a very, very good question, and actually it touches the heart of what we try to do. As reply to your question, I can already tell you, I will give a little bit more context, but we found that using the loss aversion into the model for the risk profiling and the allocation of the portfolio, we were able to get more stable investor profiles and also more stable portfolios. So let me give a bit more context. So what we did is, what we found was, if we integrate not only the attitude to risk, but also the attitude to loss into the definition of the profile of the client, then we saw that the evolution of the risk profile over time was more stable. Because typically what we saw before we did the loss aversion in the profile, if markets go up for a long time, people become more dynamic. If markets go down for a long time, people become more defensive if you redo the risk profiling every few years for regulatory reasons. If we include the loss aversion again, then we saw that the people have a more stable risk profile through the cycle, which I think is very relevant and very important. A second thing with respect to the portfolios, and again, you are perfectly right. I mean, people have also different behavior in up markets, down markets, sudden crashes, and so on. But again, in the implementation where we linked the management of the portfolio to the loss aversion of the client. So again, at the risk aversion, the attitude to risk was the guidance for the long-term benchmark, equity versus bonds. And the loss aversion of the client was a reference for the temporal adjustments of the portfolio based on a model, but also linked again crucially to the loss aversion of the client. What we saw there, and we monitored this during the COVID outbreak. So we looked at portfolios in the beginning of 2020, and we looked at portfolios mid 2020. And we all know that in March we had a crash because of the COVID outbreak, which later in the year recovered. But what we saw was that the turnover, so the action that people took in their own portfolio, was much less for those people that had a loss aversion linked to the management of the portfolio. So your question touches the point and the essence of what we try to do. I like to always use a bit of quotes. I refer to the quote, losses loom larger than gains of Kahneman. Another quote that I would like to use in this context is by Andrew Lo, is a famous artificial intelligence professor at MIT, amongst others. And he says, investing is an emotional process, like you just described. Capturing this emotional component of investing into financial technology, that's really the greatest challenge. And that's with our survey and our tool, we do a minor contribution to this exact challenge, which is turn emotionality into technology, into data that can be used in models to scale the advisory services.
Okay, thank you very much, Jürgen. Very clear. I have a question for you, very simple, because I heard that in Italy you had an agreement, a cooperation with Prometeia, which is a very well-known company, very reputed company in Italy. Could you tell us something about this agreement? And also, if you presented to our authority your approach, as you said me previously, your approach to Italy.
Yeah. Well, everyone invested includes, of course, Italy, where we have lots of people with lots of interesting investment objectives. So that's of course, a market that we want to work on. Now, yes, what I shared today, the tooling, the methodology, and the results of our survey was indeed also at some point presented to Consop, but very much with my academic hat, I must say, because it's really trying to share knowledge and to give a demonstration of, again, our modest contribution to investor protection in a digital world. And that's why I stressed in the very beginning, we call it financial personality, not necessarily MiFID regulation, but it's a financial personality to help people to get more insight in their own behavior. And that was, again, more of the academic side, accompanied with our published paper that I visited a few experts of Consop to exactly the same as I do today. The collaboration with Prometeia is very simple. I mean, I've shared today what we do as a tooling. if you want to implement that, you can do that like we did in a way of data generation. You could also, of course, immediately position this as part of the risk profiling MiFID requirement for a full investor journey. And there we collaborate with Prometea to say our tooling, if it generates risk profiles for a client, then indeed it links to a portfolio, it links to execution, it links to reporting and so forth, where Prometea today offers state-of-the-art solutions that we can integrate in a joint offering in the Italian market, but also in other markets.
Ok, thank you. So, Raffaele, una battuta finale a te, premesso che spero che prossimamente, come siamo d'accordo, troveremo il modo anche di averti, diciamo, in versione più chiara e di invitarti per raccontarci anche le vostre evoluzioni del lavoro che state svolgendo a Wealthype. I give to Raffaele the final speech, and I want to anyway to thanks to Jürgen and Raffaele for the interesting discussion. And I hope that this is the first step of the possible future cooperation between us.
Yeah, would be great.
Okay, Raffaele.
My final thoughts are more or less what I said at the beginning. I think this is pointing the right direction, because it's there are many ways we can improve the way we as a financial professionals or people linked to the financial professionals. There are many ways we can improve the situation, and of course one is to include behavioral aspects. The other one was mentioned by Jürgen, and it's which is something that we do as a company, which is keeping into account needs and goals, which is another way to move towards emotions and the real life of people. That's the point, because finance and investing is very important, but many people don't do that or do that poorly because they don't understand it, or they don't like it, even if they have the intellectual capabilities to understand it. So if we make an effort and we push the financial world much more close to the real life of people, taking into account behavioral traits, or taking into account goals, needs, practical aspects of life, I think we are going ahead in the right direction. That's my idea. I don't know if you agree.
I definitely agree, yes.
In italiano, Raffaele?
No, sì, dicevo
brevemente,
sì,
tanto si è compreso.
Sì, no, dicevo che questo appunto, come accennavo all'inizio, sicuramente è un lavoro che è un approccio che va nella direzione giusta, che è quella di considerare di avvicinarsi alle persone, in questo caso tenendo conto di un aspetto comportamentale, appunto la loss aversion, l'avversione alle perdite. Ce ne sono altri, ad esempio la società che ho contribuito a fondare è molto focalizzata sulla stima dei bisogni delle persone, degli obiettivi delle persone, quindi siamo molto peraltro è stato citato prima la logica goal-based, anche quello è un modo di portare vicino ai clienti un mondo che è quello degli investimenti, quello della finanza in generale, che sono convisti spesso come difficili, aridi, astratti, e quindi anche chi dovrebbe o potrebbe occuparsene poi in realtà è spesso superficiale, no? Anche se è una cosa fondamentale della vita. Quindi credo che questi siano approcci che vanno nella giusta direzione.
I say that Mr. Kahneman should have been very happy for this webinar, and thank you Jürgen and his team for the work, very interesting, e grazie anche a Raffaele, e speriamo di avere presto di nuovo con noi per una bella conversazione su questi temi.
Grazie mille, scusate ancora per questo ambiente un po' tenebroso, però appunto ci tenevo a partecipare e la giornata oggi è così, sono in movimento, per cui mi scuso, ma insomma, spero che...
Lo sapevamo che eri di ritorno dall'università dove hai fatto i corsi universitari.
Sì.
So, thank you to you, Jürgen.
Thank you very much.
Hope to see you again in the future for other interesting discussion. We wanted to follow you for the further development of your work, and why not also to meet you in Italy if you wanted to come here.
That would be very enjoyable, yes.
Allora, arrivederci a tutti, grazie di aver partecipato, alla prossima occasione.
Grazie mille, thank you very much. Grazie.